Well, good evening, everybody. Fellow investors, welcome to the August 2023 Investing Roundtable, co-sponsored by the Better Investing Mid-Michigan chapter and Manifest Investing. And tonight, my name is Mark Robertson. It's actually my name most nights. I'm founder and managing partner of Manifest Investing, and I'm joined here by two very dear colleagues, starting first with the guy on the upper left who got mysteriously younger from this afternoon's session, Kevin Gillogly. Kevin is instrumental.
Hello, everyone.
Welcome, Kevin. Kevin hails from the Baltimore, Maryland area / Washington, D.C., and he hangs out on Capitol Hill a little bit and runs around Baltimore a fair amount. Glad you could join us, Kevin.
Glad to be here.
And the third person of our presenters tonight is, let me get this right. I said magical. You said
you're gonna try it again, huh, Mark?
I wrote down magical.
Magnificent mathematician from mid-Michigan.
Okay, 4 M's. Magnificent.
As opposed to 3M did very well for many, many years, and we want now 4M to have just as long as a run as 3M.
So magnificent mathematician.
And I'll tell you, folks, that they accused me of owning stocks for 65 years this afternoon at the bull session. So they take no prisoners.
Why did I come up a little bit short? Was it longer than that?
Get going, Mark. Keep going here, okay?
All right. Kevin, Ken, and I will be presenting Monster, Technoglas, and NV5 Engineering, NVEE, as we get going. Okay.
Hey, Mark, this is Herb.
Yeah, Herb.
I just sent you some stuff on Five Below, so I may give a little presentation on that.
Okay. We'll try to sneak that in then. Thanks, Herb. Which one of the characters up at the top would you like me to place your head on?
I don't need it, thank you.
All right.
He will do it. He will do it anyway.
Yeah,
I know he would. He always has interesting ways to be able to find stuff in my background to be able to post.
Absolutely. All right, let's get underway. Standard disclaimer, you guys all know the rules. No investment recommendation is intended. This is an educational demonstration done to illustrate the methods, techniques, and analytical methods and philosophy of the modern investment club movement as interpreted by us at Manifest Investing and or the National Association of Investors, also known as Better Investing. So you're going to hear opinions from us about the stocks. We will be presenting companies in real time, walking through the analysis, but you must do your own homework, make your own decisions about any company that you choose to study. If we own something, we'll try to remember to disclose that. If you'd like to be placed on a reminder list for this event, it's a monthly webcast. Please send an email to nkavula1@comcast.net. Feel free to tell your friends. You can share the link to the event, and they can also be added to that reminder list. If you'd like copies of the slides, or if you have any type of follow-up questions or suggestions, our two email addresses are there at the bottom. Anything else, Ken?
Nope. Let's get this train on the road.
All right, and we're trying to spend less time on this part of the program. Again, we've been doing it since 2010. We're basically trying to outperform the Wilshire 5000 collectively. We do a tracking portfolio, and we keep track of the performance of that portfolio. We'd like to beat the market by 5 percentage points over the long term, and we'd like to have a little more than half of our selections actually do better than mirroring investments in the market. You can see that we have had improvement, guys. Here over the last month, while the market tumbled a bit during the ugly month that has been August, we actually hung in there pretty good. So we're up to 15.3 versus 10.5 for the market. So this little mark down here is nudging up against that 5% dotted line, which basically represents the type of objective that many investment clubs recognize as shooting for 15% over the long term or 5% better than the market. So the fact that we are here is comfortable. We'd like to keep that headed in the right direction and a little bit over half of our picks have actually outperformed the market. Any comments, sir?
That's a little bit of a trend up for us too, isn't it? In accuracy, Mark?
A little bit of, yeah, we've actually picked up 4 or 5 percentage points in accuracy. So that makes things simpler and better. And by the way, this 55% number is a number that was actually derived from a bunch of nuggets of wisdom from Joel Tillinghast. He's the longtime manager of the Fidelity low priced fund and low price stock fund. And he basically pointed out that 55% is a very noble objective when it comes to accuracy. Okay. Puts things in context. All right. Here's the actual top 20 holdings of the tracking portfolio. There's about 80 positions in the portfolio. What we do here is anytime at a night or a damsel or a guest night or guest damsel or the audience decides or votes for a stock, we invest $1,000 into it. The legend up at the top tells you how many times a particular stock has been invested in. You can see that Microsoft has now been, it shows up here in the legend 5 times. So $5,000 invested in Microsoft is now worth $83,000. So again, you can use that key to figure out how many times these have been repeated. Again, either by a knight, damsel, or the audience by the vote at the end. We do invite everybody here to vote. And pretty good track record. You can look at all of the positions in the portfolio by going to this public link up here at the top. Anything jump off the page here, guys?
Nothing jumps off, Mark, except that I'm real glad to see that line has turned around and moved back towards that +5, and maybe we jump over it for the next month in September.
I will point out that for fans of Ardelyx, the fourth entrant on the list there, that was at almost 450 this afternoon. So it's having quite a good run, and it isn't hurting us a bit.
So these prices are the end of trading yesterday then, right, Mark?
I think so. Depends
Okay.
on when I grabbed it, and when I might have grabbed it before it actually ratcheted over. And,
Okay.
So Herb's going to bring 5. That's down here. 5 has been selected a few times in the portfolio. It is a bit of a community favorite, and it's done pretty well. We often point out that Costco's a single time selection. Down here, only $1,000 invested is now over 11,000.
I do have a hand up in the air, Mark. Let's give Charla Hurt a chance to ask her question, okay? Charla, you'll have to unmute yourself in order to ask the question. And that must have been an inadvertent hand. I also have a hand up from Leslie Miller. Leslie, I can unmute you, Leslie, go ahead. And another inadvertent hand. So let's continue, Mark, okay?
Okay, we'll just keep rolling then. So we're going to go ahead and go into our presentations. And Kevin, go ahead and take us away with Monster Beverage.
Thank you, Mark. Glad to be here. We were talking during the bull session earlier today about Mark and I had looked at the old Arnold Bernard book on quality and how he evaluates common stocks. And we went through some of the metrics that he uses. And again, while they're different than what he did in 58 and 59 when the book was written, the premise is still very much what we see in terms of what's at Value Line right now, what we see at Manifest, and also what we talk about with the SSG. So I wanted to go through this because I found it when we were putting together a screen to look where we would go out 25 years from now, when Ken finally turned 60. We wanted to be able to show everyone that even at 60, you'll be able to still be able to do pretty well. So I decided to look at Monster, and it's in one of my 2 clubs. I'm in 2 clubs, so that's about what, 1/5 of what you are in, right, Ken? What are you in, 10?
At least, I kind of lost count, Kevin, okay?
Sounds like roundup.
Yeah. Anyway, so one of the things Mark did, and there's a public dashboard on this, and we talked about this again this afternoon, so I won't go over everything, is that I wanted to be able to find stuff that really had long-term prospects. And so we went with something with a high manifest rank, had a good core score. And in this case, you can see Monster has a core score of 275. It's those three numbers added up there. And I also wanted something, again, it's not necessarily whether the RSI is good or whether the total return is good, but whether long-term prospects are good in terms of the growth. Now, again, the growth estimates that we get from almost any screening tool are only going to go out a couple years, and we're trying to think out 25. But overall, the industry itself, it shows some real promise, and I'll talk about that. So that's one reason why I zeroed in on this one, but there are several others in there. We just started at what, about 2 weeks ago, Ken, or Mark?
Yeah, mid-August.
Yeah, so this will be something to take a look at and see as we come through. So I decided to zero in on Monster because, again, it's in the Montgomery County Model Investment Club, and that's Montgomery County, Maryland. I see a couple of our members are in the audience, so thank you. And let's go on to the next slide.
Yeah, and I did want to point out that we are intending for these to be very long-term selections, but we went opportunistic on Forward Air and I believe Solar Edge Technologies. And notice that Forward Air is the second best performer since then. So maybe we're going to make some hay with that one.
And again, in the afternoon session, during the bull session, we were looking at the high quality stocks that Bernard put out in his book in 58 and 59. And of the top 10 in there, 9 of them are still in play right now, and most of them outperform the market. So it sort of got me thinking, okay, let's see if we can find some really good high quality companies. And so here's the thing, if you look at Monster Beverage right now, if you look at the latest value line, which is up in the upper left there, you know, the metrics that we tend to look at, the price bar is above that cash flow line. So that usually tells us it's overvalued. We see the price projections are not very robust. It's only analyzed at 7 to 2%. If we look at the relative value, it's really, really high, and it's expected to stay high like that. You move over to the right and you look at the Morningstar. It only has a 2-star, which means it's it's overvalued. Its fair value is 48, and its latest price on this one was 57.34. And when I did this, it was, I think, 57. Here it says 57.03. Again, you look at that. You can also look at CFRA, and they too, all of them basically say it's okay, but they don't think it's really good. You know, in terms of really being able to pop in terms of its total return. Now, one of the requirements of stuff here for the roundtable is it's got to be actionable. So I'm going to say, I'm going to differ from all three of these. And before we got started, we were talking about Tractor Supply, is that even though these are sort of showing them as mediocre, I think there's a case that can be made for Monster Beverage as a buy. And I'll sort of walk through that. So let's go through to the next slide. So what I like to do is, rather than going through all and tell you my judgment is this, and my future sales is this, my future earnings are that, here's my high price, my low price, I'm just going to give you all the numbers right there. And what I've been doing the last couple of times I've been here is I've been doing a first cut and submitting it over at Better Investing to take a look at it. So if we go through this overall, you may sit there and say, Kevin, why is this actionable? I mean, you look at, I'm projecting a future high PE at 41, and the current PE is 42.1. You can look at in the upper right where you see the management numbers, and those are red when we want them to be green. That's not good. You look at this in the center where it's evaluating risk at a glance. Yes, it's in a buy, but since this doesn't pay a dividend, that potential price appreciation to get to 15% needs to be at 100% instead of 81.9. It isn't. If you look over on the far right where it has the SSG results summary, we want that to be 15, and we can see that that's gold at 12.7. If we look at the valuation metrics, it's clearly overvalued. And we even look over at Manifest, and the par rating it's all right, but it's not great. The one thing you can see is if you see that cap rating, I sometimes like to look at that. That's Motley Fool, their consensus among their folks. And they tend to be friskier than us. But the thing is that they're doing 4 out of 5. So they think that there's something there. So we can take a look at this, and overall, you could very easily make a case that this is a hold. I'm going to tell you why I think it's a buy. And so I'll submit that so you'll be able to see it. But let's go through and let's just talk about what the company actually does. And let's go to the next slide.
So Ken, is he using reverse psychology on our audience, or
I'm not sure what he's doing yet, Mark, but
okay?
I'm listening
All right.
very carefully, Kevin. Go on.
Okay.
All right. And so we talked about this afternoon, is that, and we ran into it with this stock in our in MCMC, is that, you know, you got to be careful if you have a really good stock that's doing well and has like sales and earnings that are above 10%, and this comes from the old manual from the 1980s, is that it may be better to stay with this stock rather than trying to get in and out and trying to time it if it's a high quality company. And this one clearly is a high quality company. So, and it does grow at over 10% for both sales and earnings. So there's a lot to be in here. And my club has owned it for coming up on 4 years, and our annualized rate of return as of last Friday was 17.7% per year. So that's really, really good. Now, I can't claim credit for being the person who presented it, and I'm not the stock watcher for it, but I become really impressed with this by watching it over the last 4 years. So let's go to the next slide and let's sort of talk about some of the things that go in here. And this is something that you added, Mark. Do you want to talk a little bit about this?
Yeah, and this is just something that we've been kicking around, because you go back to this rule, and we basically wanted to turn it into something more like an algorithm or math. If you're thinking about a company that has double-digit growth rates, you probably want to give it more leash, a little bit more room to run. And that's what Nicholson is basically saying, and Ken's going to expand on it here in a minute. But the way we always interpret that is, if it's a core holding and it's growing at greater than 10%, maybe you might want to give it special treatment. And that the point that we're making here is that for a very long time, for some of us, much of our investing career has been spent with money market rates or 1 month treasury bills. They're pretty close to each other, pretty close to zero for a lot of this time. I mean, look at this long run that we had with just this one bump here. This entire span, we were basically looking at 0% interest rates on money markets. And one of the things we do for blue chip core holdings is we consider selling them when that gets down around zero. Historically, right now, though, with this incredible increase that we've had over the last year, that number is now up to 5. And when that number goes up, the sell above, basically the price that would generate that lower return, 5.1%, has actually shrunk quite a bit. So I just throwing it out there as we're going to think more about this. But for cases where you have a core holding growing at greater than 10%, maybe you use a different number. Now, Ken's thinking about this a little bit differently. So why don't you share with the audience what you're thinking, Ken?
Well, I'm thinking that we're talking about a 5-year projection for our par value, our projected annual return, and for Monster right now, from Manifest at least, it's coming in at 10.2 for the example we're giving you. And I'm thinking if I'm going to use a 5-year projection, maybe I should be using some type of a projection with the bond rate as well. I'm not real comfortable using 5 because it hasn't happened very often in the last 20 years. And I'm thinking forward a year and a half, 2 years from now, and I'm anticipating, if all the gurus are correct, I'm anticipating that those rates are going to fall back into the 3, 3.25, maybe even lower than 3% range. And I'm saying to myself, why not look at maybe 2 or 3 years prior to the point you're at and 1 or 2 years past the point you're at, coming up with reads on those 5 years for average bond rates, and then averaging those 5 numbers together. When I would do something along those lines, then I think my target, instead of being 5.1, would be somewhere closer to maybe 2, 2.5. And that could make a really big difference if you're trying to pull a trigger on a stock that normally grows its sales and earnings at greater than 10. None of this is etched in stone. I'm doing all the math with a big red crayon. There's huge tolerances in all the numbers that I'm talking about. And yet, I think it's wise to have some trigger point that at least prompts a strong discussion on when you should sell a stock that you're in love with. And that's what is usually happening when you're selling a stock for value that's approaching a return of somewhere in the low single digits down to zero. If you're selling a stock you're in love with, you need a little bit of balance to help give you some ammunition for why it should happen, because it's way too easy, in my opinion, to come up with 50 reasons why you shouldn't. We've found that that happens in our tracking portfolio for the roundtable here.
Mm-hmm.
We set rules, and then we come right down to making the final decision, and one or two or three or four of us waffles on the rules and say, well, this is a special case. Let's continue to hold it.
That's because
So,
we're
you know,
demonstrating how difficult and challenging discipline is.
absolutely, and we're demonstrating how difficult it is to really manage a portfolio for maximum return. I mean, if we could take all emotion completely out of the decisions we're making, we might do a better job. But we know, and from our book reports and everything that we did with the gambling with Matt Spielman, we know that taking emotion out of the equation is almost impossible. So let's try to live with it.
Yep. So again, just to reinforce that we're talking about a situation where you might be looking at selling Monster Beverage at 74, and this actually loosens the leash a little bit. Again, qualifying it as a core company with strong growth, and it just moves that number up a little bit to raise the selling threshold. It just makes a lot of sense, seems prudent, and we'll probably even be talking about this more. So
yeah, we're getting a couple of our audience folks asking us questions about what the 1980s handbook says, the NAIC manual says about what numbers to use here and what to use in this case. And I think the beauty of the 1980s handbook, which we feel had an awful lot of writing by George Nicholson himself, we feel the beauty is that he deliberately avoids really strict constricting kinds of rules, and he makes suggestions and then he asks you to think about it. Nicholson just speaks about when bond rates. I mean, he doesn't get more specific than that, and because he doesn't get more specific than that, you have to kind of be vague. I guess it's the same thing that some of our friends that are analysts say, that you never mention a prediction and a date in the same sentence. Is that right, Mark?
That is true. And I think the other thing to keep in mind is, with George Nicholson at that particular point, he had been involved in investing for over 40 years. And I just finished doing a book report for our chapter on the intelligent investor. And you could see that Benjamin Graham, his work there was significantly different than what he did in 20 years earlier, or 15 years earlier. Said, I think with time you end up getting a little bit more gray areas. And I think we tend to see that also in our own, I find it with my own judgments. I tend to be a little bit more, not as hard and fast as I was when I started out. So Mark and I both noticed the same article that was in Barron's, if you have a subscription to it, from last week, that the best performing stock in the last 25 years is not Apple, it's not Google, it's not Microsoft, it's not Amazon, it's Monster Beverage. And so if you can go over into that lower left-hand side that Mark has on the manifest form, he has stuff that he's put in there about Monster to take a look at. But here are two passages that sort of struck me in this article, is that Monster excels at finding untapped niches and to keep sales coming. Remember, this is consumer defensive. They make drinks. What's a hot drink with people this year, energy drink, may not be the brand that people want to drink next year. And so the other thing is that they've learned how to adjust, and they're now branching out into alcoholic beverages. And most of these energy drinks, the overwhelming universe, are male, and they're trying to find ways and they're working on ways to target women. So there's a lot of things that are really interesting with Monsters, that they are really innovative. So if you have access to the Barron's, go ahead and take a look at that. I found that a really interesting article, and go over to the manifest forum if you want to look at more on this one. So let's go to the next slide. And so there's going to be 3 reasons why I think you ought to be able to consider this, even though, again, the overall judgments that I gave you, it's kind of wishy-washy. I mean, it is a buy, but it could also just as easily be a hold. And here's the thing. The 2 people that got this going, Rodney Sachs and Hilton Schlossberg, they met in South Africa. They ended up getting a consortium together, and they wanted to be able to get a beverage distribution company. They couldn't find one, but they did find Hansen's Natural Juices. It was in bankruptcy. They gave 1.7 million in cash, and then they assumed 12 million in debt, and they ran this. Now, that star up there is when they became co-CEOs. But they both have been there since the beginning. But one of the things with that star is that's what George Nicholson liked to do with his SSG, is he'd like to mark when that management came on there. So you can see, all right, you know, it's been a little bit different. But here's some of the things that I find that are really interesting. Monster does not carry debt. And also the next thing is that look at those number of employees. They have just 5,300 employees globally, and their revenue per employee in the staples industry where they are is 69 cents in million. So that's $690,000 per employee in the staples. Monster, on the other hand, has 1 million and 1.25 million in annual sales for each employee. That's amazing that they are significantly higher than the entire industry average. And if you look at the core, if you look at the stock comparison guide down here, look at that pre-tax profit margin. Now, yes, the 32 is really, really high. And if you go back a couple slides, and you can be able to see where we were looking at the management, and it was all in red, both for pre-tax profit, and there it is. If we look at that 32 is a little bit off, but look at that. Even in the last year where it's dropped a lot, it's at 24.25. And if you look at the return on equity, the last year on this, it's down, it's at 17%. Those are phenomenal numbers. Those are the types of stuff that we look for when we're trying to find companies. So yes, it's down, but it's not that bad. And then if you compare that 32.1 there, look at the industry average over on the far, far right. It's 16.7. So even in their down year, they're still 50% higher than the industry average. That sort of catches my eye. And so the return on equity, it's lower than the others. But of course, most of us who know return on equity is that can be skewed by debt. And what is it? The 3 in the middle that I have there, Coca-Cola, Pepsi, and then the Coca-Cola Consolidated, all carry massive amounts of debt. The only 2 that don't are National Beverage, Fizz is a ticker symbol, F-I-Z-Z, and Monster. And again, to be able to have a return on equity of 24% with no debt, that's really, really good. So there's a lot to be able to like about this. And these 2 guys, they basically are almost doing the same thing that Warren Buffett did with Berkshire Hathaway. He took a beaten down textile company and turned it into a behemoth. They got out of Hansen's Natural Juices. They sold that to Coca-Cola, but they've been innovating and going into several different areas all along the way. So let's go to the next slide. And here's the second point, the total addressable market. Now, when I put this one in there, I came up with these numbers. Again, this is from a site that I saw on Yahoo Finance, 750 billion in global non-alcoholic beverages. And if you take a look in the upper right-hand corner, that comes from Monster Beverage's investor presentation. They think that the entire non-alcoholic beverage category where they're in, that's where Coca-Cola and bottles and Gatorade and all that stuff is about 14-15%. Now, I just found a couple other citations after this. They gave wildly different numbers. But if you look at this, you know, they may only in the worldwide market, even though they're number 2 in the US, right behind Red Bull, and Red Bull is privately held, and they're from Europe, is that this has a lot of opportunity to grow. And one of their growth strategies is to be able to move into the Latin American market and other parts of Asia, particularly in Central Asia, some of the things that they're looking at. So that's one of the things that are there. The second part, if you look down at the bottom, if you see the key highlights, that too also comes from their investor presentation. And normally you don't see an investor presentation that talks about their social media engagement. Here they are. Look at those numbers for Instagram, YouTube, Facebook, all of those things. Now, I'm sure most of the people in this audience are not really up there, you know, following everything on Twitch or TikTok or Instagram. Just taking a guess here. But again, the target audience that they're looking for between 18 and 34, they do that. And one of the things they do is they have their marketing strategy is influencer marketing. If you look at it, all the people that have big algorithms in terms of people following them, those are the people they go after, whether they're sports celebrities, whether they're in the media or anywhere else. Those are the people that they work with, and they really track that as a way to be able to reach them. They're not putting ads in the TV guide. They're not putting ads on cable news unless it's in a sports or activity area. So those are some of the things that they're doing that's a lot different than what most of us in this audience would be looking for. Let's go to the third thing in the next slide. And then the other thing is they have several strategic acquisitions. There was another one that they did in 2016 with a flavoring company that they brought that in-house. But here that was for $690 million in 2016. But here it is, they're branching out into craft beer and hard seltzer. A lot of people, we saw Sam Adams is moving into hard seltzer. You can see both Pepsi and Coke are moving into hard seltzer. So there's a whole thing. They were talking at one point of being able to merge or acquire Constellation brands. That's Corona and a whole bunch of other beers and stuff like that. But they decided to do this, and this gives them their own distribution network for craft beers and stuff. And then they just bought the number 3 company in the energy drink, Bang Energy, because it was in bankruptcy for $362 million. And so that will be able to help them. And then the other thing, and this gets back to the management, is that Coca-Cola has a 19% ownership of Monster. And what it helps them do is that Monster also gets Coca-Cola's worldwide distribution network. So between having a very lean operation, they don't have the heavy weight of distribution. They're just using Coca-Cola, which has probably the best distribution network in the world. So they have a lot of things that are going for it. And that's some of the reasons why I think it's really kind of interesting. Let's go to the next slide. So one of the things that Mark and I were talking about, and I've been reading this book because our chapter has a monthly book club, is that this author, Adam Cecil, it's a very easy book to read, is he talks about how to be able to do value investing in the digital age and how to be able to think of things and how to be able to move away from a Benjamin Graham or even a Warren Buffett approach. And I found a lot of things that he talked about as being really kind of interesting and worthwhile for something like when you're looking at a Monster that doesn't always sort of show up as a big buy. So keep that in mind when you're doing it. Come and visit us. And that's the reason why I think you ought to be able to consider adding Monster Beverage. That's my report.
Very good. I'll take a look at that. Thanks, Kevin. All right, Ken, why don't you go ahead and talk about our top performing best small company for this year? It's the one we like to talk about.
That's where the idea came from, Mark. It comes from our annual list of best small companies, and this one so far this year has a 50% plus beating the market based on what the market's been doing. It's the top performer in the entire list, and it's a pretty straightforward story. These folks really mean business. The company is Tecnoglas, TGLS is the ticker. And they're the leading architectural glass manufacturer, a leading architectural glass manufacturer, and they're completely vertically integrated under one operation. And I'll explain what that means as we go through a couple of these slides. You're looking at a partial skyline of Miami, and almost all of the glass that you're looking at in these buildings was supplied by Technoglas. Consider that as we go through some of the slides. Next slide, Mark. Most of the revenue from this formerly Columbia-based company were in the United States. 96% of their total revenues in the first quarter of fiscal 23 came from the US. The remaining 4 cents from other places in the world, primarily Latin America. And I said formerly Colombian-based company, and I'll explain that as we continue in the presentation. The end market mix was approximately half-half between single-family residential and multifamily and commercial, but the multifamily commercial glass is gaining percentage as we go quarter to quarter to quarter. They have 6 strategic brands, and if you're in the building trades, you probably recognize at least one of these brands. Their windows do almost anything that you could ask a window to do. They insulate, they protect from ultraviolet rays, they protect from infrared rays. The glass is hurricane proof in many cases, and it's bendable in many cases. So they have quite a stable of brands, and they ask their glass to do all kinds of things that architects and engineers are looking for. Next step. The single family products are pretty easy to understand. It's basically windows and doors, and it's low E, which means they're very high efficient, energy efficient kind of glass, insulating, if you will. And it will supply some of the most demanding building standards that exist in the country. One of the counties that has some of the most stringent building standards in the country is Miami-Dade County, and that's because of the hurricanes that manage to slice through the bottom of Florida on a fairly regular basis there. Tecnoglas is certified in Miami-Dade as hurricane resistant. They also have many products that meet the Florida Building Code Hurricane Protection Product Standard. The commercial products are a little bit more technical, but you can read about what they're doing in the other side of this slide. This first series of 5 or 6 slides comes directly from their investor presentation. It's a fairly new presentation. It was done late last April. And if you're interested in the company, this is a great place to start and learn an awful lot about what Tecnoglas does. Next slide. They do most of their business in Florida, which is right now where they get about 2/3 of their business, but they're developing a lot of business in 2 very disparate regions of the US. They're moving big time into Texas, and they're moving big time into Massachusetts and Maine. Climate is the big issue in both of those places, hot and cold. And the glass can meet a lot of the challenges in either one of the climates. Any state that is colored a shade of blue is a state where Tecnoglas is doing business, and the darker the shade of blue, the more business is being done in that state. You see, there's still a lot of room in the country for them to grow their business, so by no means have they exhausted their customers for the kinds of glass that they're providing. Next slide. They have a huge backlog of business, and that's good and that's bad. They are managing to convert over an 18-month period from their backlog. Over 90% of their backlog gets converted to their balance sheet to profit. But they do lose a little bit of business because of their backlog, but their backlog keeps growing. In other words, their product is desired by the architects that design the kinds of buildings that need very, very specialized types of glass. I'll trust that if you're interested in the company, you'll go to their investor presentation and you'll read some of these facts and figures about their backlog, but it's amazing how much business they can book, and then they work to meet as much of that business as they can, because glass needs a long timeline for installation, and it's usually installed near the end of when the building is being built. There's virtually no cancellation in the backlog, and that's a really wonderful thing when you're talking about these huge orders of skyscrapers built entirely of glass walls. Next slide. I said they were vertically integrated, and what that means is they do it all. They have a long-term partnership with a company called Saint-Gobain, and that's where they get their sand, and sand is the primary material that you make glass from. They get the sand under long-term contracts at very, very favorable rates. And so they're able to start with raw materials at some of the cheapest prices in the business. They have a huge production process where they make the glass in Colombia. It's multi-acre, multi-billion-dollar process, and again, that used to be where the company was headquartered as well, in Colombia. The final product, the windows, the doors, and everything else that you make out of glass is made in many different places throughout the world, but it's made closer to where they're going to be installed. So they have a lot of manufacturing in Florida, for example, or in other places where they do a lot of business. And then they have a complete sales and distribution force to sell the product to architects and to engineering firms. And then they have a group of folks that actually installs the specialized glass that they sell to make things happen, whatever it happens to be. So they go all the way from the sand to the installation of the glass, and they do it all. Next slide, please. They used to be centered right there where that big blue dot is in Colombia. You can see a picture of their 4.1 million square foot manufacturing unit, and that used to also be their headquarters. They're still going to maintain the manufacturing unit in Barranquilla, Colombia, but they just moved their headquarters to Florida, and they're in the process of becoming an American company. They won't be classified as an ADR. Their stock will not be an ADR. It'll be classified and traded as an American company, and that just happened within the last couple of weeks. The interesting thing about manufacturing in Colombia is that Colombia has very few exports. Their economy relies an awful lot on things that Colombia either makes itself or on tourism dollars, and you don't need ships to bus the tourists back when they've spent their money unless they're in a cruise ship. Because Colombia exports very little in the way of hard goods, ships that come into Colombia with the many things that Colombia imports from around the world are eager to fill the hold with any product that they can take back to another port somewhere else in the world. And therefore, you get really great shipping rates from Colombia, not necessarily to Colombia, but from Colombia. So not only are they manufacturing at this huge state-of-the-art unit, but they're getting great rates on shipping it, and you can see all the different places that they ship their product. Many in the US, again, 90% plus of their business there, but also throughout South America and to a few places in Europe and even over into Singapore and Morocco. Next slide. Here's the lines. I find them compelling, especially since the pandemic. Let's say that the pandemic was officially finished with the 2020 fiscal year, although that might be a little bit early. Check that growth from 2020 to the present time. You get sales growth at 38%, earnings growth at 151%. Obviously not going to be maintained at those rates, but it's explosive growth. That's exactly the stage you like to find a small company in, when the growth is just exploding. Since 2017, prior to the pandemic, growth was not shabby. We still had sales growth from 2017 to present at 15% annually, EPS growth at 80%. I'm trying to be extremely conservative when I set my values, so I forecast sales at 18%, and then using a preferred procedure, come up with earnings at around 16%. I will tell you that I could find no analysts that are seriously following this company to rely on for another opinion, if you will. Besides what I found in Manifest, I have just my own intuition to kind of go on. But if the growth is what I told you in those 2017 on and 2020 on, then I think my numbers are relatively conservative. Next slide, please. I like the management trends. It's really nice when you see all green, and it's extremely rare. I will tell you that we've been studying building materials companies in my clubs, 2 of my clubs. And I will tell you that to find a building materials company that has debt to capital under 33% is almost impossible. Here's the exception that proves the rule. In 2022, this company had debt to capital of 32.7, which we would find acceptable. The debt is also, the company is doing a whole lot to deal with leverage, and it's still a very small company, selling just about $700 million worth of goods. So look at the debt going from 80% debt to capital in 2015 down to 32% in 2022. There's a really nice trend in the leverage for this company. They were trying to attract investing by paying a pretty significant dividend when they were a very small company. I don't consider those dividends significant, and I've taken them off. But recently, the payouts have gone down, and the company is not so concerned about paying out its profit in dividend. In fact, it's extremely concerned in keeping as much money as it can to grow the company. Payout ratio now under 10%, and the dividend's going to add maybe 0.5 to 2/3% to the entire appreciation. I'm going to use PEs of 17 and 5. That gives me an average PE going forward of 11, very similar to the 5-year average of 11.5. Current PE of only 8. Again, I think I'm being suitably conservative when I do this SSG. Next slide. Well, I'm getting a buy, nice upside downside. Look at the returns, somewhere between 25 and 36% returns on what I consider to be a very conservative take on Tecnoglas. Notice how it verifies or validates by checking what Manifest says about Tecnoglas. Manifest suggests the par should be about 25%. Again, Manifest data is coming from Y charts. I'm happy to get some validation for my analysis. I'm doing a par of 24.9. Manifest is saying 25. That's pretty darn close for me. Next slide. And the breaking news in the last week is number one, that they're going to move their headquarters to Florida and become an American company. That doesn't seem like it will accomplish very much, but I want you to think of one thing. In order to be a member of an awful lot of indexes and mutual funds, you must be an American company. It's stated in the rules for setting the index or many of the mutual funds, the ETFs that exist. So by moving to the US, excuse me, it makes Tecnoglas eligible to move into some of the appropriate indexes. Just a couple days ago, on the 28th, they broke the news that they're going to double their addressable market. Double their addressable market. I won't say it a third time, but that word was double. And they're going to enter the vinyl window category with their products. Up to this point, for residential construction, they had been dealing with metal windows and wooden windows. They're going to start making vinyl windows. They still need glass, and they figured that it's going to double their addressable market. All in all, I don't think that there's any bad news. I will tell you that in my club, one person picked up a 10-year-old article off of the internet that claimed that there were ties between the drug cartels and Tecnoglas. It was a 10-year-old article, and we could find no other article written by this person anywhere on the internet. We were kind of asking ourselves the question, was there any truth to the article? We could not find any type of recent confirmation of that information, and we're thinking it might have been somebody trying to pump the price of a very small company at that point and trying to influence the stock price. Again, there is one article out there for you to find. It's a treasure hunt if you want to go look for it, but we could not find any validation of that particular 10-year-old rumor. All in all, I would suggest that adding $1,000 to Tecnoglas is a good thing, and that's what I'm going to add to the roundtable portfolio, and I urge you to consider it tonight.
All right, Ken, I just got to admit that was kind of a weak moment. I had just finished watching Romancing the Stone, and I was kind of swayed by that when I pointed out that article, and we really appreciate this update. And what do we call this? Romancing the Sand or Romancing the Glass?
I'm not sure. I'm going to answer Shirley's question. Shirley says, where is the headquarters going to be? It's going to be in Miami. Do you anticipate increasing debt in the transition? No, they already had major offices in Miami, and they're going to use the offices that are there for their world headquarters now. Joe wants to know if back orders are high, how is Tecnoglas going to expand? They're already talking about breaking ground on more building space, both in Columbia and in Florida, Joe. And that's the only three questions that I'm going to answer out loud right now, okay?
Okay. Well, thanks, Ken.
And I have one question. When will they be on the indexes in the United States?
I don't know of any specific indexes that they're going to immediately move to. All I know is that moving the headquarters to the US will make them eligible for many of the indexes. And for example, they will now be eligible for the Russell 2000. Now, whether that will get them there or not, I don't know if it'll happen tomorrow or 5 years from now, or if it'll ever happen, but they become eligible by becoming a U.S. company.
Okay. Well, Ken,
So for the time being, they're still in ADR.
No, they will not be an ADR. This is an American company now.
Okay.
Okay.
All right. Well, whatever they need to do, Ken, I'd like them to do it before Halloween.
Okay. All right.
Get them on the line and get them working on that. All right, let me close up with my inspiration for my selection for the evening. Just basically looking at the opportunity to build infrastructure in the United States. We've talked about this a number of times, so I'm not going to belabor the point. Yes, that is an example of my wiring skills on the upper right. I try not to misbehave too much, but this type of stuff is going on throughout the United States infrastructure, and it does need to be repaired. And no, that is not a water tower in Ken's backyard down on the lower left. But there is infrastructure that is needed and necessary. So it was part of our electric portfolio to go out and find some of these type of companies. This one didn't make the cut, but it's a pretty formidable one. Quick stock screen, looking for companies that have high top 1% with respect to the return forecast and the quality, in combination with companies growing faster than 7% and with a relative strength index under 40. So we're looking for a company that might be a tiny bit on sale. It's a pretty good list to study. From MP Materials, they've got an event which needs to happen. Paycom has been popular. ZTO is all in a lot of radar screens. Microchip Technology is a fascinating study. I wouldn't be surprised to see that come back here soon. ResMed, formidable competition from Inspire. There you see our company, NV5 Global, that we're going to cover here. And there's some pretty good studies on that list. Here's a quick look at the company using the resource that Kevin was talking about tonight. The value line at value line at value line. Yes, you heard that right. The price is below this line. So it's basically a little bit undervalued. The major thing that we see here is the word infrastructure twice. I'm not going to repeat it 3 times like Ken, but infrastructure is here twice. And this company is in some very strategic areas with respect to utilities, construction, real estate, environmental, and basically building buildings well and putting together systems that are quite effective. So that's what it comes down to. Really decent business overview that's not too dated from Dickerson Wright, the chairman and CEO, that you can look at on their investor relations site. One of the key areas that we talked about in our life after Google and the electric portfolio stuff is these data centers, which are just massive, and they have to be built well and efficient and all that kind of stuff. And these guys do that, from the solar and the wind and the renewable energies to the actual farms for the data center, and then also the infrastructure, the physical infrastructure. They're involved in all that kind of stuff, including the transmission towers that we talked about during the electric portfolio. And they have either acquired or merged with some very capable entities in that realm. Here's a look at the company with respect to some of the key characteristics. We see a quality rating over time that is basically hovering in the good to excellent zone, so that's pretty cool. The projected return has been a little bit of a roller coaster, and it is, if you squint a little bit, it is kind of near multi-year highs. Fairly consistent sales trend. The track record is fairly consistent. Most of the dots hit the trend line. That trend line is something in the realm of 10 to 12%. So we are looking at a medium-sized company. There is in that sweet spot that we have talked about fairly frequently over the last several months with small and medium-sized companies. So the earnings trend has been pretty much up straight and parallel. The stock price has followed the earnings, so everything here looks pretty good. The projected return, low teens, it is confirmed by the projected return on value, and we have a high quality company. There's a lot to like here. Decent financial strength, fairly steady stuff. Here's some of the other stuff that we look at with respect to any company. The margin has been consistent and it's improving. It's going up from left to right. The net margin at the bottom line, which generates the EPSs, has been hitting on all cylinders, and it's doing pretty well right now. So we'd like to see that continue. But even if it does achieve the levels expected by the analysts, that still is near historical highs. The PE ratio is not out of control. It's in that 20 to 25 range. In terms of some of the stuff that we'd be looking for, very low debt. What debt that they do have is at 2.48%. So that tells you what the banks think of this company. In the Hugh McManus mode of trying to find companies that are trading within 20% of their low price, this one is at 11%. That's attractive. Value Line has gone a little bit conservative on the company. And oh, by the way, it's now in the standard edition of Value Line. It was in the expanded edition. And they're a little conservative here, in my opinion. The Morningstar analyst thinks it is wonderfully on sale. And the general analysts who follow the company, those rhinos, believe that it is also on sale. It is at near an oversold condition, so it is potentially attractive in the near term. So I'm going to go ahead and add NV5, citing it as an infrastructure opportunity, company that has, in a very excellent way, served their markets, and we hope to see that continue. Ken, I would consider this probably a candidate for our list here over the next couple of months.
Absolutely, Mark.
All right. Just a quick reminder that last month I did go with TNA, or one of the Russell 2000 index funds, whatever you want to do here. This happens to be a triple leverage thing, but again, it continues to hover down here. It has come up a little bit from where we first started talking about it, but we have our eyes on that type of opportunity as a potential from the smaller companies right now. And again, we dubbed these guys the Little Rascals in honor of Ken and Darla. All right.
So is that one gonna? Do they sell hot dogs? Is that what gets them like that?
No, but that dog probably likes hot dogs.
Yeah, I'm sure the kid does too.
I took Portillo's out tonight, guys, for the first time in a long time. I failed to mention Portillo's.
You want credit for this, huh?
Okay.
Are we going to hear from Herb, Mark?
Yeah, Ken, do we have time, Ken? I think we can.
It's just 9:30. We probably do have a little bit of time. Sure.
Okay, let me go ahead real quick. Why don't you see if there's any questions to field, and I'll see if I can.
I'm looking at the questions right now. Give me a chance, folks.
I'm in the wrong place here. I'm sorry.
Joe wanted to know with Tecnoglas, if they expand, what will that do to their debt? Joe, I don't have an answer for that, but I'm confident that the management is keeping an eye on the leverage of the company, and it's a capital-intensive company like any other building materials company. That debt could go back to 45, 50, 55% and still be well in line with the industry average for building materials companies. So at 32, it's low right now. They have some room perhaps to take on a little bit more debt and still keep their margins where they'd like them. Anitra wants to know, oh, I've answered that one already. Okay. Jaya, I think Jaya has asked, any thoughts on the political stability of Colombia itself? I think that I'm going to stand on a soapbox for just a moment. I think that if we still see Colombia as a drug-ridden murder capital, then we're playing with a script from 15 years ago. I've watched a lot of material recently on Colombia, which indicates that the country has gotten the problems of the cartels fairly well in hand, that it's become a tourist mecca. The city of Medellin, which was a place that was known as the murder capital of the world. They had 30 plus murders per day in that city 15 years ago, is one of the safest cities in the world today. And it's being done without a police crackdown, without any kind of police state. Colombia has turned the corner as far as joining the more stable nations of the world. And they're beginning to develop industries that fit the resources that they have. One of those resources, of course, is great beauty, and so tourism fits the bill for for this Central American company. I keep saying company, country, but I don't think it fairly carries the title of unstable anymore. I just don't think you could call the country unstable. I think that it's reached a point where people feel safe in the country and where they're doing real things with a real economy, not based on cocaine. So
Cool.
I'll get
Well,
off the soapbox
we-
now. And
We
Mark
better shut you down before you start talking about law enforcement equipment, and then
Yeah,
we'll
yeah.
lose you on that.
Okay. So let's go to Five Below from Herb Lemcool then. Herb?
Yeah, thank you very much. Five Below is a leading high growth value retailer offering trend right high quality products loved by tweens, teens, and beyond. We believe life is better when customers are free to let go and have fun. An amazing experience filled with unlimited possibilities, with most items priced between $1 and $5, some extreme values priced beyond $5, and our credible Five Beyond offering. Five Below makes it easy to say yes to the newest, coolest stuff across 8 awesome Five Below worlds: style, room, sports, tech, create, party, candy, new and now. Was founded in 2002, headquartered in Philadelphia, Pennsylvania. They have over 1,400 stores in 43 states. So I thought it was kind of interesting when I look at the stock selection guide, and you see the growth there that Mark is showing up. It's continually growing up. The sales got hit just a little bit, but now they're doing much better. When I go to my stock selection guide, you know, I have a 13% historical sales growth, where the past is 21. Historical earnings per share at 15. Now, this is an old SSG, and I have to tell you that I have this stock in 2 of my clubs. One is in the Cool Kids, and one is in the Port Value Investment Club, and I am the stock watcher for this club, for this stock, and I just now, just the last couple of months, have taken that on. So I think it's rather interesting when you look at this stock that, you know, the earnings release is going to be tomorrow. So last year's sales were 3.86 million, earnings per share 469. The average payback on a new store is 1 year. The current price is 182.68. This is a company that just continues to grow. Even when I looked at the value line for last month, or for last quarter, we like Five Below stock mostly for the buy and hold crowd. Indeed, we think the retailer's vast selection of fun, trendy, bargain price goods gives us a leg up on competition regardless of the economic conditions. The recent price quotation that ranked it neutral, but capital gain potential for 3 to 5 year potential is really, really well. So I think this is just a short presentation, and I appreciate the opportunity to be able to do it. And if anybody has any questions about it, I'd love to hear them, because it's going to be interesting to see how the stock performs on next week after the earnings call.
One of the things I like about this one, Herb, is it is a company that's in the roundtable tracking portfolio, and it's got a legacy going all the way back to Nick Strategos out of Pittsburgh, originally bringing it. But then there was also that magical moment early in the COVID outbreak when Cy Lynch picked the stock, and all of us sat there and said, but their stores are closed. And he said, well, first of all, they're not all closed. Second of all, they're going to open them back up again. And that means that Cy was buying this company at the bottom of that really dreadful price spike back in 2020. So, I mean, you look at that type of stuff and the recovery that the company has had, it is firing on all cylinders, and just an interesting company to watch. So
Herb,
Yeah,
I will tell you that the Wolves, my investment club, my personal investment club, also owns Five Below. We were supposed to have a report last night on Five Below, and we postponed it so we could wait for the earnings, which were coming out, I think Thursday they're coming out. Is that right? Something like that?
The
But,
30th, after close on the 30th, yes.
But our stock watcher is just very, very positive on Five Below, as well as you are. So I think that it's a great one to put in, to take another position in our tracking portfolio, and I think it's going to help add to the performance. I'm going to launch the poll right now, Mark. Here we go, and the poll is open. So I'm going to ask you folks in the audience to pick one of the stocks that was presented tonight, or if you didn't like any of them, pick none of the above. We always have a few people that pick none of the above. We're sorry we can't give you a stock you really like, but we try real hard. I think we've given you some pretty good things to ponder here this evening. Small, medium, large companies.
I just want to comment about, somebody asked about the debt. It started out in 2019, and I think that's when the federal government required that they declare the ownership of their stores as a debt.
The leases on the stores, right? You're right, Herb. Yeah.
Yep.
And that's why the debt has done what it's doing. This is a good time if you're looking at the debt for Five Below. You might look up interest coverage, what it means. Then you might go to the ratios tab in your SSG Plus, and the ratios tab will give you a real quick read on interest coverage. If it's double digits, then that means the company is doing fine. And I'm reasonably positive that Five Below has no debt problems. We've just jumped over 80% voting. We'd love to have it up to around 90%. It doesn't cost you anything to vote, folks. So take your mouse, and I'm going to kind of count to 10 backwards in my head here. And we'll see how far we got. 86% right now, 87%, 88%. Come on, let's push that thing to 100 if we can. I feel like I'm on a telethon right now. Okay.
Yeah, I feel like I'm on the PBS telethon.
PBS. Okay. Well, I'm going to close the voting. We got to 89%, and I'm going to share the results. And the results were Tecnoglas getting
Lapping the field.
About half the vote, and Monster Beverage giving it about a quarter, with the vote distributed among the rest. We still have 1% of you saying none of the above, so we'll have to work on that so we can get that down to 0.
And Ken, I want to caution you against asking for votes. You can be indicted for that. So. Okay.
Did I ask for votes? Okay.
I'm just kidding. I'm kidding. I'm really kidding out there.
Non-political, remember. Okay.
All right. On the non-political side of things, we do have just a quick reminder that we do post these sessions, the roundtables and the bull sessions, on the YouTube channel, Manifest Investing, and you can go back and look at some of the stuff that we've done over the years. And here are the coming attractions. We do have bull sessions every Tuesday at 2 if you want to check in and join us for that. And the September roundtable will be the last Tuesday in September 26th. Ken and I will do the October roundtable, and we're going to combine the best small companies for 2024 on that date. That'll be a special session, more information to follow, but we didn't want to do it on Halloween evening. We'll do it on All Saints Day, which I believe is the next day, November 1st. And Ken and I will be in New Orleans a couple days after that. And we are working on a special event, which will be a series of educational sessions in December with the date to be determined. Anything else you want to add, Ken?
No, it's been a good session. Thank you so much to the folks that help us out during the year, to Ann and to Matt and to Kevin and to anybody else that's just taken the time to do a presentation for us at the roundtable. This is a program that for me is a lot of fun, and we've been doing it for a long time, and it never ceases to amaze me that we can draw as many people as we draw to it. So again, Mark, we couldn't do any of this without your continued support and help. Thank you so much. Even though Cy and Hugh aren't here tonight, thanks to them for being such loyal followers of the program. And we'll see everybody on the last Tuesday in September.
All right.
Good
Thanks,
night, all.
everybody. Good hunting out there. Happy Labor Day.